So, welcome everybody to Landon Realty Group's weekly seminar. This seminar is on a huge topic that we always get, which is how to invest in real estate. One of the things that we notice is all these TV shows that are teaching people or showing people flipping properties or improving them and then reselling them is everyone thinks they're an investor. And a lot of times they don't know what it takes to actually do the investment. I'd like to introduce the people that are going to be on the podcast today. We have Ivan Vasquez. I'm going to hand him over as host today. Ivan, want to say hi? I can't hear Ivan. Am I missing? Does anybody hear Ivan, or is it just?
No, I can't hear him.
No, Ivan.
Okay, there you go. Hi, Ivan.
Had a little bit of audio issues. So I just wanted to go ahead and dive right in, I guess. Excuse me for being a little bit late with the internet and such. But today's topic is really 6 ways to invest in real estate today. Some of the information you'll be getting is going to be from Jordan Musk, president of Mortgage with Augusta Financial, and of course, our lovely broker, Jennifer Landon, owner of Landon Realty Group. So if you guys would like to share a little bit about yourselves with the rest of our audience, that'd be great.
Absolutely. I'll go first. That's okay. So I am a broker and owner of Landon Realty Group. I've been in real estate since 1999. Grew up in real estate. My dad was a general contractor, was constantly on job sites. So I always like to say I'm in my family's business. I own a real estate appraisal company, and I also have an investment company. So I've helped a lot of people make money in real estate, and it's a fun place to be. Jordan, how about you?
Oh, thank you. So I'm the president of mortgage banking with Augusta Financial. We are a mortgage banking company in Southern California, one of the larger ones in that area. And we are a full-service mortgage bank, not a depository, but you can't come in and get a checking account or a car loan. But we are a bank that funds real estate-related transactions, whether it's conventional loans with Fannie Mae, Freddie Mac, whether it's jumbo loans, construction loans, bridge loans, or a real estate bank. I also run a private equity business with a partner. I'm a real estate broker, and as mentioned, I've got a couple rental properties here and there. So I think that owning real estate is one of the ways that dumb schmucks like me can actually increase their net worth. And I'm not going to start an app or found Facebook. So real estate is basically it for normal people to set themselves up for long-term success and a stable retirement.
I concur, and I'm going to challenge you on the dumb schmuck because Jordan is no dumb schmuck. He is extremely smart, which is why I invited him to come today. He and I have partnered on a few things. I've known him for a very long time, and I value his business sense thoroughly. So I think we have a great panel here, and we have some of the top ways, the 6 ways that people can start to invest in real estate. And Ivan, do you want to kick us off?
Yeah, so rental properties, owning rental properties can be a great opportunity for individuals to, increase their cash flow. A lot of people think it's simple, and while it may be simple, if you have the right team, it can also be a very complicated process to go through. So Jen, can you talk to us a little bit about, rental properties, pros and cons, or anything in your experience with rental properties?
So rental properties is probably the number one way people start investing in real estate. It can be a great way to have passive income. For example, if someone has a single family home and they're able to finance a second home and rent out that home, that's usually how most of the time it starts. There are other ways to invest in rental properties, such as 2 to 4 units. Usually most people would not live in it. You can. And then from there, you can jump into the commercial market with 5 or more units. The only thing about rental properties is you have to stay up to date on all the current rental laws, especially in the city of LA. They are very strict, and they're very strict, and there are guidelines that you have to go by. And we have seen kind of this market. I don't want to say it's frozen, and Jordan can speak to this, but it's not. With COVID and the moratoriums that's been happening in the city of LA, a lot of owners are not sure what to do next or what's coming. What do you think, Jordan, when it comes to this moratorium that we've had to deal with in the city of LA?
Yeah, and the moratorium doesn't affect most landlords. This moratorium affects your larger property owners, apartment building owners, owning multi-units. So just to be clear, your typical landlord, as you mentioned, is usually the person that owns a house, buys a bigger house, and keeps their existing property as their rental. Or your mom and pop landlords that might have a property or two. Most of them are not governed by LAHICD's different rules. But yeah, I mean, every large scale apartment building is, every multi-unit building pretty much is. And right now I've unfortunately got properties in the city of Los Angeles that are multi-unit. So you've been unable to raise rents for a couple of years, which hasn't been that big of an issue. A lot of landlords are stuck with the foreclosure or the eviction moratorium. That has gotten better as a lot of state and federal capital has come in to catch people up. But yeah, I mean, it's going to persist through 2023. It did get extended yet again. I would look at that more as a kind of almost a once in a lifetime type event. We hopefully will not see this again. The bigger issues with rent control in the city of Los Angeles have to do with registering your properties. You will get visited by them for inspections every couple of years. There's some paperwork to do. There are various fees to go through. So it's not particularly fun. They also do limit your rent increases much more so than the state rent control law, which is 1482, I believe it is. The LA City rent increases are much smaller. Some are typically in the neighborhood of 3%, sometimes 4%, depending on the year. As you mentioned, this has led to properties, multi-unit properties in the city of Los Angeles, turning over less frequently. They are sitting on the market longer than something outside of the city of LA, where the market is a little bit more robust. You can look at that as an opportunity that you can get a better deal with a better cap rate, for example, which refers to how the property is calculated, how the income of the property is calculated, which directly leads to the sales price. Maybe you can get a better deal in the city of LA if you're willing to take on some of that. Other people just don't want to deal with it, and so they avoid it like the plague. Personal preference.
Yeah, I agree. And to clarify, single family homes are not subject to the moratorium, correct? I mean, those are just
correct. And I think if you're a smaller landlord, I think if you own less than 4 total units, I don't have the rule in front of me, but if you're a smaller mom and pop landlord, you're not subject to the rules, even if you've got like a duplex. Don't quote me on that, but there are some rules where you can get yourself around LAHICD's rules.
You're absolutely right, Jordan. My dad is one of those small and pop landlords who owns a duplex. He lives in one of them, and he's been fortunate to have very good tenants. However, he's had to make some adjustments, and has had to ask some of them to leave. And they did fight back. Oh, you can't do that. But we did do our research, and you are correct. Small landlords that occupy one of the units from the duplex, they are exempt from all those crazy rules and stuff like that.
And owning rental properties as an individual, as Jennifer mentioned, definitely has its pros and cons. I think the biggest thing, leverage is probably the number one pro, because you're putting down, if it's a property you already own that you're converting to a rental, you're not outlaying any additional capital. If you're buying it as a rental, you're still laying out some capital, but all of the appreciation is yours and yours alone. And the leverage factor tends to be huge in those circumstances, at least in California. Some of the rest of the country, you might not have any appreciation, which changes the game a little bit. And you also need to be pretty, you have to, this mentions substantial capital. You do have to be liquid, because if there gets to a circumstance where you need to do a repair, I'm redoing a condo right now, so that'll be a $30,000 check when it's all said and done. You have to be liquid and be able to cover expenses and not put yourself in a position where you're stressing about having to do improvements or repairs or not getting paid rent for 2 or 3 months. It's not for people who have limited reserves. It's not the right thing for them to invest into. But it is one of those things that does get easier as time goes on, because you're a little bit more spread out and a little bit more diversified. It's actually easier in some respects having 3 or 4 rental properties versus just one, which sounds crazy, but that's the way it works out.
And just to clarify, is anything that they would purchase that's under 4 units that would be subject to qualifying on their own income, but once you get to 5 or more units, which we're going to cover in the next couple slides, that would be commercial. The property qualifies the buyer, correct?
Correct. The easiest way to think about it is that 1 to 4 units, you need to qualify for the loan and you need to qualify. When you go to 5 units, the property needs to qualify. So
right.
When it's 1 to 4, you're going off a standard matrix. For example, we'll just take Fannie Mae's to make it easy. On a 3 to 4 unit property, non-owner occupied, Fannie Mae's max is 75% loan to value. If you qualify based upon theoretical rental income, current, your own job, things like that, that's a done loan. That's it. 75% of the property's value is what will be financed. On a commercial loan, it's completely different. Commercial loans don't care about how much you make at your job. They want the property to what's called debt service, meaning that when it takes into account all expenses, they want the property to break even. And if that means that your loan amount is only half of what the building is worth, then so be it. And there's also a little margin of error that gets built in there. So if the rents are low, your commercial loan amount in proportion to the purchase price is going to be very low. So residential, you need to qualify. Commercial, it's all about the building. And that's because a commercial lender goes off the theory that they might have to foreclose one day. And they want the building, if they foreclose and take it back, they want to be able to manage that asset and not lose every month on it. That's the way to think about it.
Right. That's and just people don't realize that. So I think it's good to know. So, all right. So I'm going to go back. Can we go back one more slide really quick? I'm just going to list the pros and cons. So the pros are rental incomes provide regular income, and properties can capture appreciation. They maximize capital through leverage. Some tax deductible associated expenses. The cons are it can be tedious to manage tenants. Tenants potentially can damage the property, and reduced income from potential vacancies. So like Jordan said, keeping some liquid assets aside to make sure you can cover anything that any shortages. All right, so rental properties, I think that's the most obvious one. What do you got for us next, Ivan?
So our next slide is going to cover real estate investment groups, also known as REIGs. I don't know if there's a pronunciation for that, but I'm not going to try it. So real estate investment groups are ideal for people who want to own real estate without the hassle of running it. Investing in REIGs requires a capital cushion and access to financing. Jordan, I'm going to defer over to you on that one because it has to do with financing. So take it away.
I can make this real quick. I don't know of any financing options for you to invest in this. So usually something like these are structured as LLCs. So I don't know of any way you could finance that or leverage that. I think you just need to give them a percentage. If you're going to buy into 10% of it, you need to give them a bunch of cash. that being said, there's all sorts of strange financial products out there in the world, so nothing would surprise me. But usually something like this requires you to just throw in cash because you're getting a share of the overall building. Now, I shouldn't say that. The LLC or the group that is buying this set of apartment blocks or condos, they could be obtaining financing in order for leverage. But if I'm John and I'm investing in this LLC, no one's going to help me invest. I need to give them cash. The LLC itself might be going out and getting loans so that they can leverage, just to clarify.
And I agree. I actually worked for a company that did this, and what they specialized in was in apartment buildings. So they had an investment group, and they put different partners together that had money to invest. They would just, take their amount or their share. Then they would take the money, they would pool it together, they would buy apartment buildings, they would clean them up and raise the market rent, and then they would sell them within 2 to 5 years. And then everybody that was part of the group would get part of those profits from their initial investment, and then they would take the other part and they would reinvest into new buildings. So they were quite profitable. They would capitalize on markets that did not have rent control because they could come in and raise the rents, and they had enough liquidity to do enough improvements to the building, and to carry it during that time, and they saw really good profits. So that's an example, but that is for people that have maybe a chunk of money, like $500,000 to $1 million even, because some of these purchases start at between 5 and 10 million plus improvements. Would you say that's accurate, Jordan?
Oh, for sure. They're typically buying the big stuff. When you see a 30, 50, 80 unit apartment building sell, it's very often things like this that are real estate investment trusts, or even these groups of individual people. It's not one person coming in. It's typically a conglomerate. And that conglomerate gets financing on it, and everybody invests there. I'll take a 1% stake, I'll take a 5% stake, et cetera, et cetera. They're buying big stuff. The disadvantage you've got here is that you're investing with other people and you don't have a say in things. You're not involved in a day-to-day basis. And typically there's a managing member or a management company as mentioned on this slide. So the good news is that it's a very much a passive investment. The bad news is it's very much a passive investment. And if you feel like they are not operating the correct way or operating in an efficient or profitable way, your choice is basically to just go along with it or to get out and sell your share. You're not going to have any type of control.
Correct. I agree. All right. And I think we have some pros and cons on the next slide. Let's see what they are. You know what? There we go. They're pros are the more hands-off than owning rentals. Obviously, there's none of that maintenance that comes with that. Provides income and appreciation. The cons are vacancy risks, similar fees as mutual funds, and susceptible to unscrupulous managers. So, yeah. All right.
Where we can vet those managers, right? Like there's.
I know. I love it. All right. What do we got next?
So house flipping. A lot of you watch HGTV, Bravo, or Lifetime. It's a very fun thing to watch. House flipping is for people with significant experience in real estate valuation, marketing, and renovation. House flipping requires capital and the ability to do or oversee repairs as needed. Jen, I know firsthand you flipped a few homes, so I'll let you talk a little bit about that, and we'll see what you say.
Yes. So a primary portion of my business is actually working with investors. I think that I got into that because of my appraisal background. We were able to identify, properties that were not to their full potential and identify how much to put into it to maximize the return on investment. A lot of people, if they do not have the access to contractors or the help or the vendors that are needed at a reasonable cost, they can over improve or overpay for the improvements, and also over improve the improvement to where they don't capture the money back. So it looks easier on TV than it actually is all I'm going to say. And timing is also really important here. I mean, holding costs can really take up a lot of your profit. So you want to be careful and have a really good plan and know who you are working with, or if you're doing it all yourself. It is a lot more work than it seems, but it's a beautiful thing when it does work out and it makes people a lot of money. But this whole, speculative and investing this way, a lot of people feel like that they're sometimes going to come into the market and all these people are flipping and we're upset what's happening to the neighborhood. But what they don't realize is they're raising the property values in the neighborhood. They're bringing the neighborhood back. And because a lot of these houses, they really need improvements. And what I'm finding as an agent is people, they either have if they don't have the time, they don't have the money to do it. And if they have the money, they don't have the time because they're working. So it's a beautiful thing to be able to walk into a house that's done. What do you think, Jordan?
I think the TV shows make it look too easy and that every deal makes money and nothing ever goes wrong. And it's so much fun. You get to pick out all these furnishings and tile and flooring, and it's just a great, wonderful thing. It tends to gloss over the heavy carrying costs that are involved unless people have a tremendous amount of capital themselves. And it has, with the exception of a couple short time periods, quite frankly, it's been an easy market to flip in the last 8-9 years. You really almost couldn't lose money. If you are generally someone that has no comparative advantage, if you're not a contractor that can't do the work yourself, ultra cheap, if you aren't somehow getting the property well below market, there's really limited money to be made. You have to have some type of advantage over everybody else to be able to make money doing it. By the time you factor in the time involved, by the time you factor in the carrying costs, et cetera, you either need to be getting that property significantly below market, or you have to have some type of advantage when it comes to construction. And I think people who do have those advantages can do quite well. We've seen that time and time again. We finance several different flipper groups, and most of them do well. It's just a question of where are you going to do that better than somebody else? Because if you buy a property at market value and you have to hire a contractor and do all that, there is no way you can make money realistically. By the time you have your carrying costs, your improvement costs, your labor, your materials, your real estate costs on the way out, et cetera, there's almost no way. You have to have some way that you're going to do it cheaper or you're going to do it better than somebody else. And there's a lot of groups that do very well doing that because they specialize in it. They run their own crews. They don't have any financing costs, or they're able to acquire properties below market. So for certain groups and people, it's an absolutely winning strategy, and the market has done really well for them over the last almost a decade now.
Right, but it's about the reality check on what is really involved. And with California, Southern California specifically, most homes now averaging buy-in at $1 million. You're looking at, okay, you're leveraging $1 million plus you have to have your holding costs for, I would say, depending on what you're doing, minimum 6 months. Most can take up to a year if you're getting permits, that you're paying for something that seeing no return on the investment. Plus you're forking out, easily. Most of my investors are a minimum of 250,000 in improvements, upwards to 500. So before you even go back to market, you can be in it for 1.5, and then you still have to sell it and recoup your money and hope that the market doesn't shift. So to say that it is can be stressful is an understatement. So you really want to know what you're doing and have a plan. But it is a great way, and it's a lot of people have been talking about it. So yeah, house flipping. So let's see the pros and cons. So you want to read those off, Ivan?
Sure. So some of the pros are it ties up capital for a shorter time period. Another pro is it can offer quick returns. Some of the cons are it requires a deeper market knowledge, and hot markets cooling unexpectedly. Like the stock market, they go up, they go down, sideways. You just never know. So it's good to have a great team like Jen or Jordan to kind of guide you through this if this is something you want to get into.
And what I always tell my investors when they're going into a property is, especially right now where the market, we don't know where it's going in the next 12 months, is you have to know exactly what your exit strategy is and how long it's going to take you to get there. And if something shifts, what is the backup plan to get out of it to at least be able to cover costs so you're not taking a loss. And I'm telling all my investors right now, whatever you have in your bucket to complete, get it done before the end of the year, because we don't really know what the 2023 projections are going to be. And I've heard varying opinions on that, but nobody knows. But right now things are still good, so we want to move property as quickly as possible right now. All right, go ahead. Number 4.
Next slide, it's a real estate investment trust, REITs. A real estate investment trust is best for investors who want a portfolio exposure to real estate without a traditional real estate transaction. Jen, if you can elaborate a little bit more on what that means or what it is.
So this is very similar to the other. I believe it's more in a trust format, and I'm to be honest with you, it's extremely similar, but it's paid out in dividend stocks, where I feel like the other is an interest in the company. So I think that's the main difference, but they do the same thing. Jordan, what would you say on that?
Yeah, these can be bought and traded, kind of like almost like an ETF or like any other stock. Big disadvantage is you don't really necessarily know what's in them half the time. You could have thousands and thousands of properties and office buildings and malls, and if you like some of them and don't like the others, it doesn't matter. You have to kind of take all of it as it is. 2 of the big ones, Simon Growth Properties comes to mind, and General Growth Properties were in the news a lot the last couple of years because they owned a ton of office buildings and malls. And that's stuff that during COVID has been challenged. So it can be very concentrated into certain investments, or certain types of investments, I should say, like, for example, malls. I think it's one of those 2. I think both of them actually, were heavy into malls. The good news is, of course, it's super passive. You just buy it and forget about it. You also can 1031 into them, which is kind of fun. If you sell a rental property and want to defer the tax, you can actually put it into a REIT. They tend to have kind of higher fees, which is taken into account because they're doing all the management. So, and by law, a REIT has to pay out, I believe it's 90% of their income to investors to be classified as a REIT. The downside there is that tends to leave them capital challenged. And typically they're leveraged. They've got loans on all their stuff. And they can't keep a whole lot of capital on hand because so much of it is required by law to be paid out to their investors, kind of like a dividend. So in times where there's challenges in getting paid for the rent and all that, there have been REITs that have essentially failed because they can't keep massive amounts of capital cushion. It's just, people like them and some people don't. Like anything else that we've talked about today, there's pros and cons. I don't think it's something that would normally be looked upon from most real estate investors. They tend to like things where they can pick out assets and have a little bit more say in what they're investing in. Most REITs tend to be quite large and are typically diversified across many markets, which could be a good thing as well.
I agree. So it's more like buying stock that is specified in real estate in a way, and it's a broader scale in relation to the REIGs. So yeah, so okay, excellent. And what's the pros and cons we got for this one?
So some of these are essentially dividend paying stocks. Core holdings tend to be long-term and cash producing leases. Some of the cons are leverage associated with traditional rental real estate does not apply. So one of the things that did stand out on this topic was dividends. Anytime I hear dividends, I just hear like little coins trickling in my brain. However, it's a much more complex thing to get into. So I'll just stick to with what I know. But yeah, I like that word dividends. It's my favorite word.
I like it too. I think we all like it. All right.
So online real estate platforms, real estate investing platforms are for those that want to join others in investing in a bigger commercial or residential deal. The investment is done via online real estate platforms, also known as real estate crowdfunding. It still requires investing capital, although less than what's required to purchase properties outright. Online platforms connect investors who are looking to finance projects with real estate developers. In some cases, you can diversify your investment with not much money. So, Jen, take it away.
I don't have a lot of experience with the online platforms, and I don't know if this is like the best example, but there are some new online platforms where you can invest in certain homes and actually have a percentage of usage of that property. I don't know if that's exactly it. I've never done this before and done the crowdfunding. Jordan, have you?
I've come across them several times, and it is just one of the worst ideas ever. And it's the usual theory from a tech company that there is an app or a tech solution for every problem. And so, without saying any specific company names, the general theory is that instead of, for example, let's say a developer wants to borrow some money to either flip a house or build a project, and instead of going to a bank or going through a private money lender or traditional financing, we could just raise it through crowdsourcing, and we'll get $10 from John and $40 from Bill and $100 from Timmy. The problem, as with anything at the end of the day, is that the tech company or the arranger is taking a chunk of it, and they don't really care whether the project succeeds or not. They're not holding any of it on their books, and they don't really care what happens in the long run. I mean, they say they do, of course, but they really don't. And some of the absolute dumbest private money deals I've seen over the years have all come out of crowdfunding platforms, because the website looks good, and again, someone's putting in $100 or $5,000 or $1,000. They tend not to be super sophisticated of evaluating these things, because they don't have a ton of money to invest, and they might be new and all that, which is great. And most things in real estate require a lot of capital, and this is a way that's being pitched to individuals that invest for as little as $100. Yeah. When the market corrects itself, and every cycle the market goes through a correction, these are the worst loans we have seen. They are all done as crowdfunding because it's it's $100. How much investigation do you have to do to invest $100 kind of thing? And it's all done via these apps and all that, and everything sounds great. It's going to be something that's going to perform quite poorly in times of market stress, and it's just a matter of how long it's going to be until that occurs. So it's a wonderful idea. I understand the thought process behind it. Unfortunately, there's just not enough involved there to protect investor money.
I think that was a great explanation, and I agree with you. And if you only have $100 to invest in real estate, I'd say wait till you save a little bit more and do something a little bit more specific. So, all right. So I guess let's go over the pros and cons, and then let's.
Some of the pros, you can invest in single projects or portfolio of projects. Geographic diversification, and some of the cons, it tends to be illiquid with lockup periods. So like Jordan was saying, in times of bad performance, your cash is kind of tied up and you can't really get it back or do anything with it. So
agreed.
Yeah, I also agree with Jordan. It does sound like it's probably one of the worst things you can get yourself into. So I'm glad that this provided a little bit of information in case I came across it and it sounded nice and looked nice. Good to know that it really isn't.
Yeah, if it looks
they always have great looking websites, really flashy, great looking websites. I'm jealous of whoever they hire for web design and all that. Great apps and great websites.
Well, that's where all the money goes, is to the website.
So next, we're talking about home ownership and capturing appreciation. The easiest way to invest in real estate is personal home ownership. In 2021, California homeowners captured an average of 20.3% increase in value just by owning their home and capitalizing on market appreciation. For example, $1 million increase in value by 200,000 by taking no actionable steps. So Jen, if you can talk to us a little bit more about that and what you've seen in your own experience of people who have bought a home and then all of a sudden have a whole bunch of equity just by doing nothing.
And I think that's what I want to get back to. This is our last point. And even if you don't have the extra money to invest in rentals that you're not living in, just even owning your own home is the best real estate investment you can get. Now, you don't want to get caught in the trap where you spend your appreciation. You want to keep it in your house as long as possible. But just owning a home, you're already investing in real estate and are technically an investor. One of the best things you can do is also capture the capital gains write-off that you get on your home. So after living in your home for 2 years, you get a $250,000 tax shelter when you sell. So I always explain to people, if you're not sure if this is going to be the house you're in forever, once you know you hit that mark, that you've maximized your deductions tax-free, then think about selling if it's after 2 years and move up, because you want to capture that. Or if you can fund another property and keep your property as a rental, make sure you move it within 2 years, because you can still capture that deduction. And that's really one of the smartest things that you can do by even living and in your own home. What do you think, Jordan?
Well, I mean, this is the lottery ticket. So there's, no appreciation is guaranteed, but over the long run, California real estate tends to appreciate. I'm not sure that using the 2021 number of 20% or so was quite the fairest way, but that's a valid number. And even 2020 was, I don't remember what the number was, 12% or so. Over the long run, you'll be fine. I always tell clients that in the short run, who knows, 6 months, 18 months, 24 months, you never know what the short run is going to bring in California real estate. But I know that over the last 150 years, over the long run, you typically can't lose. There had even been, only I think 1 7-year period of decline where if you bought at the peak and sold at the trough in 7 years, you would even lose. So generally, over the long run, you're going to be fine. Kind of like the stock market in a way, if you're properly diversified. The difference with home ownership is that, first of all, you need a place to live anyways, and you get the leverage factor. Leveraging yourself on stocks through margin is scary. Leveraging yourself through real estate with low interest rate, fixed rate loans is pretty darn smart. Most of the property appreciation that I've seen on my portfolio, of course, over the years has come just from appreciation. The $1,000 a month you pay your loan down doesn't really do a whole heck of a lot. It's the market appreciating around it. So it's not ever a guarantee, but over a longer period of time, it's a pretty darn certain thing. And the biggest thing is just making sure that you don't have to sell. So if there is a rough period that you've got yourself into a fixed rate loan that you can afford, you've got some cash squirreled away in an emergency account to take yourself through the rough points. And then it's just kind of a sit back and wait type thing. The value of leverage of only having to put down on an owner-occupied property 5-10%, but you get all of the appreciation despite the fact that you're leveraged to 90% of the value of the asset is an amazing thing. There is basically nothing else in life that you can utilize like that. And it's the way that people generally build the most wealth is through real estate ownership. Again, as I said in the very beginning, my chances of starting Facebook is relatively low, or the next Microsoft or Apple. So this is the way that quote unquote normal people can pretty much still have an almost guaranteed increase in your net worth over the long run. No guarantees, but if you look at history, just the last 100 years in California real estate, you not that you can't lose, but if you're careful about it, the odds are in your favor.
And one of the things that really points this out too is, you look at these bigger companies that have sustained over the years, and I'm going to take McDonald's, for example. One of the things that they changed in their industry was they bought the property that they put their stores on and their restaurants on, and it changed everything. So whether it is your business or your home, owning where you're at it gives you, it shields you from all the rent craziness. It allows you to rent it, but you make the money on the buy is what they say, and it is true. So you want to make sure you're making a smart decision in that no matter what, you can carry it through any ups and downs, because there will be ups and downs. But so the smartest way, if you're not able to do any extra properties, is at least get into one yourself, which I think is the smartest. I've never, what is the quote? Don't wait to buy real estate, buy real estate and wait.
I think most people, you almost have to be uncomfortable. And in looking back, whenever I've bought stuff to live in personally, I've always looked back at later, and it was always a great decision, but at the time it seemed almost borderline crazy. And I think a lot of people, if you're in that escrow to buy your first place or to buy a place you're buying up to, and you're not a little bit uncomfortable, then your brain's not working right. The human brain is designed to warn us of danger and warn us if we are putting ourselves in an uncomfortable position. And I would say that, Jen, you'd know probably better than I, but I would say at least 8 or 9 buyers out of 10 get a little bit of doubt, a little bit of cold feet, a little bit of nervousness when they're in an escrow. And you're talking median home price in most of these areas at well above $1 million now in a lot of parts of Southern California. If you're buying $1 million house and you're not a little bit nervous, I'm impressed, because I think it's just a normal reaction. And you might not have, you might have to grow into that house a little bit. It might feel a little bit uncomfortable at first. It certainly has for me over the years, and everything's worked out. But I think that's a very common feeling and a very normal feeling, and the way you should approach it. It's one of the biggest decisions and biggest purchases you'll make in your life. And it's totally natural that you kind of have to grow into that first or second house. No question.
I agree. You triggered a story. I was doing an appraisal for this gentleman that was quite well off. He had a beautiful, huge estate in Toluca Lake against the golf course, and his wife had passed away. So I was doing the appraisal, and he asked me to do an appraisal for his beach house in Corona del Mar, which, if anybody on the call knows that area, it's a very expensive high-end area. And I was laughing because he said, yeah, I remember the day I bought the beach house in Corona del Mar. He's like, I made the offer and I came home and I was sweating. He's like, because I was like, what am I doing? Why am I spending $250,000? That property was worth $3 million. And so he's like, and now it was the best decision ever, but he didn't know that at the time, and he still had to make the payment in the meantime. But that's why it's just a beautiful thing. But you don't want to go in with the over expectation of a great, huge payoff and just allow that to come. But just knowing by getting in, you're making a great decision already. So if you can carry it,
For owner-occupied, for an owner-occupied residence you're going to live in, just think of the appreciation as a lottery ticket. You're insulating yourself from rent increases because you're generally going to have a fixed rate mortgage. So you're protecting yourself from rent going up 3, 4, 5, 6% a year. You're giving yourself a place to live, and you're giving yourself some stability. And the appreciation is a lottery ticket, just with way better odds. Really, really, really better odds is the way that I would look at it.
I agree. So there's something a little bit for everybody here, right? It's for the person that just needs to get into a home to get that equity building and to get going there. Someone who's ready to step up and maybe get a rental property or a second home. And then for someone that has some cash, maybe they inherit money and they want to put it into one of these investment trusts or groups. It's all amazing opportunities. I think Oprah said it best. She said she always loves to buy real estate because they're not making it anymore. So it's a tangible asset. And as we get more technological in crypto, it's so nice to have something that actually is real and, that you can actually go back to and exists. It's really kind of cool. So do we have any pros and cons here for us, Ivan, on this last one, home ownership?
We sure do. Some of the pros are little to no capital improvements need to be done, personal use of property during ownership. Some of the cons are it's subject to the rise and fall of the market. and no passive income to offset the debt service. Um, those are the ones that we have today. I just wanted to add a little bit to what you were saying, Jen, about appreciation. For those of you that don't know me personally, I'm a big Jay-Z fan. And in one of his songs that he laid out recently, he said that he could have bought a house in Dumbo before it was Dumbo for like 2 million. And now that same building today is worth 25 million. And then he ends it off by saying, guess how I'm feeling, Dumbo. So just, just a little good, musical background there for you guys. But if even people like Jay-Z that have massive amounts of money look back and say, man, I should have bought this when, it was this price, and probably at that point probably scared him a little bit, like Jordan was saying, but now it's worth 25 million. I'm sure he would have been that emotion of fear would have sure disappeared, and it would turn into joy that now he has a $25 million building. So I definitely
It's it it's about reorganizing priorities too. I mean, I think a lot of people when they're younger, they're prioritizing their car or vacations or even their clothes. If you take that money and put it into where you live, in 10 years you will have money, or you'll be able to control your costs because your mortgage will have stayed the same and your income will have gone up, and you'll be able to afford the car and the shoes and the house. But if you do it in the reverse, you'll just be living in your car.
I hope it's a nice like yours, Jen, at least.
I guess they're living in their Porsche. All right. So why don't you bring us home, Ivan?
Yeah, so all in all, the bottom line, whether real estate investors use their properties to generate rental income or to
Bide
uh,
their time. Yeah.
perfect selling opportunities arises, it is possible to build out a robust investment program by paying a relatively small part of a property's total value up front. And as with any investment, there is profit and potential within real estate, whether the overall market is up or down.
I agree with that because most investors are waiting for that down market. They don't want to buy on the up. I just will say, because there's probably some people on this call, it's like, I'm going to time the market. I'm going to time the market. This isn't like trying to catch a surf wave, people. It isn't like, the sets are coming threes. And so you just wait. The last 15 years have been so unprecedented. I don't even know what timing the market means anymore. So, hindsight's 2020. Woulda, coulda, shoulda. You're gonna shoot yourself in the foot. Just get into whatever you can afford that works for you, and just get in and get it started, because that's how it works. What do you think on that, Jordan? Timing the market.
Yeah, I've been hearing the same thing from buyers for years, that they're waiting for the right time to buy. I don't claim to ever understand when the right time to buy is, because it's only on hindsight that you're ever going to actually know. I don't think anybody predicted in March or April of last year, or 2020. We were all kind of running for the hills thinking we'd see a pretty substantial decline in the market, and we're up probably well over 30, maybe 33% since. Nobody saw that coming, myself included, and I've watched this market every day for 22 years now. So you can never time the market. And if you can time the market perfectly, you're probably doing something. You're either getting lucky or you're just way smarter than everybody else. And I don't believe in that. Unless you've got some type of insider information, it's just not too likely. So at a certain point, you just have to kind of jump in, close your eyes, and hope for the best. I hate to say that because it makes it sound like it's just crazy, but that's what people do. We saw the trough coming out of the 2008 crash. I think the trough was right around 2011, when we had a ton of short sales and a ton of foreclosure activity. And I don't know of anybody in late 2011 or so that told me that was the trough and told me that was the time to jump in. And I don't remember anybody telling me in early 2007 that was the peak either. So no matter how much reading you do, how much blogs you do, how much blog reading and everything else, or YouTube videos, no one knows. And it's only in hindsight that anybody looks back and tries to claim that they knew. So, and I am by nature a pessimistic person. I tell people that I've predicted seven or eight of the last two recessions. So, and even I never would claim that I would know the right time. You go with what feels right. If you're an investor, it's actually easier because you set yourself a criteria, whether it's a yield you're looking for on your rent, whether it's a certain number you're looking for appreciation that you think is going to be there, or a certain cap rate on commercial property. As an investor, it's actually easier. You set yourself some metrics and it becomes a logical decision. It either hits the target or it doesn't. If you're buying to own or occupy into a market like this, where rates have gone up and purchase prices have certainly gone up and inventory is relatively low, it really just becomes almost a leap of faith, for lack of any other better term. And I've watched thousands and thousands and thousands of people make that leap of faith, and overall, it generally works out fine. So there's no guarantees in life, but this is one of those things that over the long run, you have to feel pretty confident about.
Well, I feel like it is a leap of faith, but it's also a way of controlling your costs, because, you know, how much do we pay in rent these days? Sometimes it's over half of people's income. So with rents all over the place and they're increasing, and as it's going to be harder for people to buy, I'm seeing more pressure being put on the rental market. For the first time, I'm getting people calling me saying they can't even find a rental, and I'm like, what? This is nuts. And their family.
I can tell you a quick story that'll blow your mind. So I recently listed a 2-bedroom condo for rent. I looked on apartments.com and Zillow.com just to get a sense of what market rent was. My tenants had been there for 7 years in this unit, and I really had no idea what the market rent was. When I bought the unit 7 years ago, it was about maybe $1,550 a month for rent. When they vacated, that had slowly gone up to about $1,900, I believe. I listed it at $2,500. Believe it or not, that was the cheapest 2-bedroom condo or apartment in the market area. And I had 47 inquiries, and of those 47, at least 10 of them wanted to apply for it and take it sight unseen before the first showings. And they all said exactly as you just said, that there was nothing for rent, and they were literally desperate. And this is, that is what, a 75, 80%, 70% increase in rent price, just over 7 years. So if you own, you're able to control that expense. You're on most likely a fixed rate mortgage. Your property taxes in California under Prop 13 are relatively fixed. They only go up a tiny percent each year. Your insurance doesn't generally change too much. You are taking your housing expense and essentially locking it down for the next 30 years. And I will tell you, if someone had done that in the last 7 years, the last 2 years, the last 3 years, versus what I'm seeing out there in the rental market, you are feeling very fortunate. Because I don't know exactly the reasons for what's going on out there. I've heard various theories, but it is brutal, absolutely brutal. And my heart goes out to, I had people literally begging me for what is essentially a entry-level condo. So it's very strange.
It's so strange, and I don't see it changing. I see more pressure being put on the rental market than ever before. I do kind of blame how easy it was for people to keep their home as a second home in a rental and then buy another one. But we can go into that later. But still, that essentially that a second home should have been available to the rental market. But I don't. So again, going back to it, getting in and getting into something, you control your costs, you control, being able to live there, because, as Jordan, as an owner, he could give that person notice and say he's selling it, and they'd have to go. So as long as they're not under a lease. So buying is protection. So a lot of good information here today. I hope everyone feels enlightened. Is there any questions from the audience that anybody would like to ask before we wrap this up? No?
It's so good they don't have any questions.
That's good. That means we were thorough. All right. Well, do you want to wrap us up then, Ivan?
I do. On behalf of Landon Realty Group and Jordan with Augusta Financial, I want to say thank you all for coming. As always, you can find us on social media platforms, including Facebook, Instagram, LinkedIn, TikTok, and YouTube at landonrealtygroup.com or at www.landonrealtygroup.com. This seminar will also be available as a podcast on Spotify, Keeping It Real with Landon Realty.
Yep, keeping it real estate. Pun on words.
The three dot talk, like how many seconds do I pause per period? I think it's like 1.5 seconds. I don't even know how to time that, but I did my best.
Oh, you did great. And thank you, Jordan. You're awesome. As always, Jordan, how can they find you?
We'll get my information over to you on email, but best way is the main office number is completely fine, 661-260-2970.